Hi everyone, welcome to another honeystocks.com stock market outlook video, and this one is for the month of August. Now, before I do the usual and switch over to my screen share and walk you through a lot of the charts and data that I know that many of you tune in for, I just want to say that I've been absolutely humbled by the number of emails and messages that I've received over the course of the last month. I don't think there has been many analysts and many firms out there that have been calling for massive bullish rallies. You can go all the way back a month when I started posting a lot of bullish charts, presenting the data as is. And of course, the month of July has been absolutely incredible. So I do hope that you've done very, very well, not just from my charts, but it has been a very challenging year so far, especially for long-term investors. So I hope a lot of portfolios have had some kind of recovery. But thank you to those of you that take the time to comment, like, and of course reach out. Now, there's obviously a lot of interesting data that's presented itself over the course of the last couple of weeks. We've got another Fed interest rate hike to deal with. We've got the yield curve which continues to decline, but we have had some massive rallies, and that's showing itself at the index level. So let's dive into some charts. Now, before I do that, I just want to get it out there that I'm not a day trader. I think if you have a longer term outlook in the market, if you are weeks to months and looking for longer term trends, then you might get a lot more value from my work. If you are trading on minute time frames and trying to time little 5 cent, 10 cent moves, there's no point in watching my work. You're not going to get any value from it. So let's dive into the charts. Let's see what data we have. And if you do get some value, please do hit the like button. Thanks. Now, before I get into the charts, please pause the video. Make sure you're comfortable with that before watching any further. It basically just says that there's not any investment advice. Do all your own due diligence and don't be silly. Just to give myself a little bit of credibility, I'm working my way towards my CMT, likely going for my CFA quite soon. And a few of my recent calls, I understand that in this game it's really a case of what have you done for me lately. Back on the 23rd of June, I made a bullish call on stocks, bonds and cryptocurrencies when everybody was losing their minds. Now, over the course of the last 4 weeks, if you follow me on social media, Twitter, and you pick up my weekly letter, you'll know that over the last 4 weeks I have been posting bullish charts. Now, what I want to just convey is that many of the charts that I'm going to be talking about today, I have made recommendations to our clients and members over the last 4 weeks. I may hold a position in some of the stocks that I'm going to be walking through. So for disclosure, these are the charts that were recommended last week to our clients and members. All the charts 2 weeks ago, 3 weeks ago, 4 weeks ago. A couple of things to note here with the Chinese names. PDD did not break out, and QD actually ripped 70%. That's certainly all of the charts that I've communicated to our clients and members over the last few weeks. And like I said, I may hold positions in some of these names. I have made some other calls in the last few weeks with really calling for a pause in energy back in the 8th of June, which was played out perfectly. Some of you will have seen this chart all over Twitter. Made a bullish call on cryptocurrencies. Ethereum has moved 90-100% already. If you want to go a little bit further back, where the carnage started back in November of last year, highlighting the probability of a small cap decline, which, if you understand the market, it is a gauge of, it's a good barometer for risk sentiment. We've got the S&P 500 doing exactly the same move on the 5th of January, again highlighting the failed breakout and how that worked out 2 months ago for the small caps. Again, controversial letter at the time, but turned out to work out. 3rd of January, the valuation reset, and you can go all the way back to 2020 I think the point that I'm trying to make here is that in this game, it's worth listening to individuals that are mostly correct. Not always correct. Obviously, nobody is always correct, not on every stock, not on every chart, not on every data point, but mostly correct. So feel free to check that out. And if you do get some value from this, like, subscribe. Now, let's just quickly start with a broader market overview. Now, this chart is a little bit busy, I understand, but let me just quickly walk through this. This is the month of July. This is the S&P 500 over the last 70 years. We can see that July has outperformed and has been absolutely unbelievably good place to be over the course of the month of July. We can see the same thing with technology, triple Qs. That's what this little blue diamond is. It tells us that it's outperformed. And again, we've seen the same with the small caps. So we've had an incredible seasonality effect. July is generally quite a positive month. But I think even when I put out my bullish thesis at the end of June, I probably didn't expect July to work out as well as it has. But for those of you that follow my work, you'll understand that it's really about risk to reward propositions for me. The bet I was essentially making when I put out the letter on the 23rd of June was that these levels would act as some kind of support for stocks. Now, common sense tells us that when the mega cap tech names find support, you're going to find the other major averages kick on with it because of the weightings, because they are cap weighted indexes. But really, we can see historically with the triple Qs, the 200-week moving average has historically been a decent buy point, and that's what we've seen so far. The big question that everybody has is, are we dealing with a bear market rally, which I'm probably leaning more towards than a definitive bottom? But one thing I do understand is that these levels in the major indexes are holding up for the moment. So it's all very, very encouraging at the moment, but when we get into August, it could well be a different story. So it's really just a case of judging every individual chart on its merits, not overthinking the broader market too much. But again, we found that these levels are holding up. But the small caps will probably have a little bit of a battle next week, in my opinion. We're looking at the AVWAP levels from the COVID crash highs and lows. So I do expect a little bit of chop with the small caps. The bonds, we can see that the financial crisis back in 2008, we dealt with a 17.7% decline before there was a massive rebound. The question that I'm really asking at the moment is, with the COVID crash, we've had a similar comparable decline at 17.3%. We've got massively oversold conditions. And for me, the risk to reward proposition is probably to the long side. But I am very, very mindful that risk management has to come into play. So always have levels where the thesis is proven to be incorrect. We've got a failed breakdown potentially with TLT as well. Now, added to that, we've got the US dollar index, which has been a massive headwind for stocks over the last 6 months. Just to explain that, the dollar's been going up, the S&P 500 has been going down. I don't think I'm going to break any internet with that knowledge, but just to show it visually in a chart, very, very basic chart, as we can see, the US dollar index has been going up. There is a massive inverse correlation, but as we can see, as the dollar index has been declining, it's no surprise to see the S&P 500 rally. So for me, watching the US dollar is key to everything. I think if the US dollar, of course, continues to decline, then that will probably be bullish for stocks. We've got the 10-year Treasury note yield potentially breaking down. Again, those of you that follow me on Twitter will know that I posted this chart the other day. So Again, it will be interesting to see what happens there because of the inverse correlation with the 10-year note and with bonds. I would expect if there's follow through on that downside move, then you would expect TLT, IEF, AGG to move higher on that news. But the elephant in the room is, of course, the yield curve and recession. Now, again, it's quite a busy chart, but what these shaded boxes essentially are the recession period. Shout out to Optima, who are my charting providers. They sent me a message on Twitter today just showing how I could improve the chart a little bit. And certainly the US recession data, we can see that when the yield curve inverts, which means drops below zero, we can see that a recession usually follows. We had a very minor recession, of course, with COVID, but as we can see here, we are starting to decline. We are below zero. We've had, depending on, I guess, the shifting narrative that we're finding now, what constitutes a recession. We've had 2 quarters of negative GDP, and for me, in my world, that is a recession. I don't understand how it can be argued otherwise. So the question is, how do stocks really do when we have a recession? Typically, they don't tend to do too well. That's why I'm leaning more towards a bit of a bear market rally rather than an outright market bottom. But really, I am open to all possibilities. The market, just when you think you know what's going to come next, it wouldn't surprise me in the slightest if we go and hit new all-time highs in the next 2 months. It really is a case of being open to all possibilities because nobody really knows exactly what comes next. And I think that's something to bear in mind. If you pay attention to investors and individuals like Michael Burry, for example, Michael Burry has got a massive bear target on the S&P 500. This is the chart that I think he's working with. He's basically saying that when we have two crashes, the crash dips lower than the previous crash as per the chart, and I think that's probably what he's seeing here. We've had the 2020 crash, and he thinks that we can decline a lot harder than where we are currently. But certainly that's Michael Burry's view. I'm not going to argue or go against somebody with that reputation. So again, just to reiterate, I am open to absolutely all possibilities. But that said, my approach is really along the lines of judging every individual chart on its individual merits. So I have around 20 individual stocks that I am going to be covering this weekend, and we'll see how it plays out. I have covered many of these charts over the last few weeks. Many of you have asked for updates on these charts, so that's exactly what I am going to provide. Now, with Netflix, we can see that it bottomed. Again, I did cover this. It met our target 10 days ago. We've had earnings, everything's out the way, and it has broken out. So for me, again, I like to utilise things like trailing stop losses just to remove the guessing game of what if. I like to have a systematic approach. I try not to act on feelings. So certainly, bear that in mind. Now, again, some of you will have seen me post this chart to Twitter over the last couple of weeks, just highlighting that this is on failed breakdown watch. Very, very simple. I'm using the RSI momentum indicator, using historical comparisons to show what levels we can expect some kind of rebound in the stock. It is absolutely played out perfectly. Posted this chart to our members and clients back on the 5th of July, and it looks like it is now putting in that failed breakdown. At Microsoft, very, very straightforward chart. We have earnings out the way. Look to be pretty decent from what I observed, but we are seeing that this is a key level for the stock, and it is holding up perfectly at the moment. So I think, provided Microsoft is above these levels, I think it's a dip that you can probably buy. stocks like Microsoft, Apple, etc. They really are no-brainers in my world. Massive move on semiconductors in the last couple of weeks. Thank you very much, Nancy Pelosi. Again, for those of you that picked up my charts last week, you'll know that I with Nancy's information, it was a pretty easy call to make. But it's off and running. The massive semiconductor chip bill, I think, has made it to the next stage, if not past already. So that's going to be quite interesting. But again, Nvidia, great company. It's really just a case of what comes next with the market. But I certainly like Nvidia. I think if we started to dip hard and undercut these lows, I would expect $115 to come into play. But at the moment, I think it makes a lot of sense to be long. INMD, probably the email thank you, the one that's probably kicked in the most over the last couple of weeks. I posted a chart for INMD to Twitter, and of course we can see that it's absolutely ripped higher. I think with INMD, many of you have been asking for updates on this one. It's really just a case of just, in my opinion, just using some kind of trailing stop loss. There will come a point where you'd probably look to look at pivot levels, $42 to see how far the stock ultimately wants to go. But given that we know that this was previously traded at $100, it's breaking out of a base bottom, which, if you follow my work, I don't like to buy downtrends blindly. I like them to set up again, and usually that means paying a little bit more for the stock sometimes, but having the security of knowing that it is breaking out of a base, and you can manage the risk a lot easier rather than just buying blindly all the way down, which it is a great company. Those of you that have done that, congrats. I'm sure you'll be fine over time. But Apple has posted earnings. It has went out relative all-time high against the S&P 500. Again, I made a bullish call on Apple a few weeks ago based on using Fibonacci, and it's holding up perfectly at the moment. I probably expect this to go and test all-time highs in the next few weeks. Big failed breakdown in the steel index. Again, I posted this chart to Twitter the other day. The move today, I think, was 3%, 3.5%, something like that. And again, we'll see how that one moves. Something to understand is that a lot of these areas of the market move and can move a lot quicker than a lot of growth tech names. You tend to find a lot of the names aligned with steel are pretty low when you talk about PE ratios, etc. So again, I'm looking very much, and that's the target. I think as long as you're above this $50 level, I think again it's an area that you can be long. A lot of you have asked about an update on ARC. ARC met our target 2 weeks ago. Thanks very much. I think if it breaks out above this level, then it probably becomes interesting to me. Or, of course, if it dips back to the low end of the range, range-bound charts are very, very appealing because you know where you can buy, you know where you can get out, and there's usually a favourable risk to reward. This is one of the charts from our members and our clients' sector ETF chart book, which all of our members have access to every single day. Big level of interest coming up for AMD. Again, in our social media analysis a few weeks ago, I made a bottom call on AMD, and I think this is a level where you'd probably want to maybe pay attention if you are trading the stock. Of course, if you have a longer term investment outlook, that's a different conversation. But if you are trading the stock, then I think that's a level you probably want to pay attention to. Lots of you asked for updates because of my social media video a few weeks ago. Just time to buy the dip in Amazon when Amazon was down at 100. I think you want to pay attention to this level at around $145, $150. I think that's a logical next challenge for the stock. But congratulations everybody that has bought in. Again, don't use the magical hindsight indicator. Costco bottomed a few weeks ago, and I would expect the 570 level to probably come into play. PayPal, again, I posted this chart to Twitter. It has broken out above its 50-day simple moving average. Again, it is supported by a bullish divergence, and again, just applying a trailing stop loss on it, see how far it wants to go. There's no point in second guessing it. It has been beaten to death, but like I've been saying to pretty much everybody, all of our clients, is if we are not looking at stocks that have been decapitated, 70-80%, and you're not starting to look for long opportunities, then what are we even doing? I think it makes a lot of sense to look at a lot of these beaten up names, maybe just test the water a little bit. Don't need to get aggressively long or aggressively short. Again, that's been my message to my clients and members over the last few weeks. There is opportunities if you know where to look and if you are prepared to put in the work. Again, not overcomplicating things. Base bottom, bullish divergence. This was a recommendation in last week's analysis to our clients, broken out above 100-day simple moving average, and it's had an absolutely monster week. Earnings coming up next Thursday, I believe. So if you have missed out, it will pay to keep an eye on earnings for Crocs. We may find that it provides some kind of earnings discount. What the earnings discount essentially is where a stock reports great numbers, but the stock sells off. It usually represents an opportunity to load up. We have Sonos. Again, last week's recommendation is bouncing from a very, very logical level, and I think with Sonos, I think most of us that understand sound, certainly my TV, soundbar or music system that I absolutely love Sonos, and I'm quite happy at seeing it rebound from these levels. American Express, again, looking for base bottoms. I think it makes a lot of sense. Shopify, again, we've got massive support level in place. I think we've had earnings now out the way. That chart was provided, I think, on Tuesday to our clients. Sideways range, buy at the bottom, sell at the top. Nothing complicated. Massive breakout this week in ANET. It has reached an overbought condition. I would never advocate buying a stock outside of the optimal buy range, which is really what my work's probably known for. But I think with us being in an overbought condition, I think this one makes a lot more sense on any kind of pullback, potentially to the 105, 110 level. I think could make a lot of sense. Massive sideways range for Avis Budget Group. Again, we covered this one 3 weeks ago, and it's absolutely ripping at the moment. We've got CMG. Again, I love Chipotle as much as everybody else. It's up 30%, massive support levels. I think what I would probably want to say to those of you that are still watching is, for my work, I like to pay attention to historical support levels. You don't need to get overcomplicated with technical analysis. I think, if you hunt around social media long enough, you'll have all the gurus telling you that this moving average, crossing that moving average, supported by a MACD and cross signals. For me, a lot of that is just complete nonsense. You can really do pretty well with technical analysis if you just have an understanding of support and resistance. And this is another example of that. We covered this one on the 22nd of June in our members midweek halftime, and it's been a massive performer. So paying attention to these charts. I understand most of you watching won't have the time to move through 2,000, 3,000 charts a week like many of us professionals do, but certainly basic support and resistance would be the message. And if you are still watching, please do hit the like button. It tells me that you're getting a lot of value from it, and of course it all helps with the YouTube algorithm. Now, Tesla, massive breakout on the back of I think earnings. and it's off and running. I'm fully expecting the momentum in Tesla to continue. I think if you are short Tesla, if you are advocating being short Tesla, I've got no doubt I'm going to receive a lot of angry emails on the back of this. But if you're advocating being short Tesla, given what you know has happened in the past to the shorts, you probably deserve it at this point. It's never a stock that I would ever recommend going short on just because of the nature. I get it, fundamentals, etc., but it is one of those names that you don't want to be caught on the wrong side of, and I'm fully expecting that to go and test all-time highs. But like I said, if you have had value from my work, again, please do hit the like button. If you are somebody that is wondering who I am, what it is I do, well, I have a charting service at honeystocks.com for professional, retail, institutional clients. And what our memberships provide are access to all of my premium work every single weekend. We provide our premium analysis to our clients and members, provide investment ideas, provide a short midweek halftime report, provide access to a wonderful investing trading community. You have complete access to my ETF and sector chart book. And if you are somebody that is looking to learn technical analysis, we also provide full access to what I'm told is a very comprehensive technical analysis program, which I used to charge a lot of money for, but I now just include as standard with absolutely every membership that we provide. But just to quickly show you what our high conviction investment ideas look like, this is a recent short recommendation on commodities which met our downside target. Again, Zillow was a pretty obvious short. We've had Box, again another short, but we do provide, of course, massive opportunities to the long side as well. And certainly Cloudflare was massive. Antero Resources, believe it or not, is still going strong. It's up towards $50 odd now. But I am very, very unique. As most of you already know, I timestamp my work. You can go back and have a look at all the high conviction ideas that have been sent to our clients and members over the last 4 years. The purpose of that is really just to show you the types of stocks that we recommend, and certainly the dates that they're recommended and how those stocks then go on to perform. So please do check that out. But I think my work will be a good fit for you if you've maybe got a longer term, mid-term approach. If you're maybe looking to get away from day trading, maybe you are just way too busy with work, family, business, life to get on top of a lot of the areas of the market that us professionals obviously are paid to keep an eye on. And maybe you're just hunting around social media and you're sick of it. I think if you are looking for somewhere to stop by, I think we're probably a good fit. But please do all your own due diligence. We do have membership limits as well. So of course the membership can be closed at any moment, but please do check out our website. And if you have stuck around to the end, thank you very much for watching, and maybe I can welcome you soon. Thanks as always.